If you've heard about the Roth IRA 5-year rule and felt confused, that reaction is normal. The problem is that people talk about the 5-year rule like it's one rule. In reality, it's a timing framework that depends on what kind of Roth IRA money you're withdrawing and how your situation is classified. In this video, I'm going to explain the 5-year rule in plain language, show you the timeline logic people get wrong, and give you a practical checklist so you can avoid mistakes and make clean decisions. Comment 5-year if you want the checklist pinned. I'm Alex from Wealth Architect, where we build wealth with mechanics, not hype. Before we start, a quick note. This is educational content, not financial advice. Roth IRA rules can be nuanced, and your situation matters. If you're making an actual withdrawal decision, review official guidance and consider professional help. Now let's build clarity from the ground up. A Roth IRA can contain different types of money, and the type matters because the rules treat them differently. In simple terms, there are 3 main categories you should think about. Category 1 is contributions. This is the money you personally contributed to a Roth IRA within the annual contribution limits using after-tax dollars. Category 2 is conversions. This is money that came into a Roth IRA from a conversion, such as converting from a traditional IRA or a traditional 401k into a Roth IRA. Conversions have their own timing considerations. Category 3 is earnings. Earnings are the growth in the account. Dividends, interest, and capital gains that accumulated inside the Roth IRA. Now here is the core concept that keeps people from making basic mistakes. Rules often depend on which category is being withdrawn. Contributions are treated differently from conversions. Conversions are treated differently from earnings. So when someone says, "Can I withdraw from my Roth?" the first question is not, "What is the 5-year rule?" The first question is, which type of Roth IRA money are you withdrawing? Now let's introduce the term qualified distribution, because it's central to the Roth IRA timeline conversation. A qualified distribution is a withdrawal of earnings that meets the conditions to be tax-free and penalty-free under the general Roth IRA rules. That usually involves both an age or qualifying event condition and a timing condition, including a 5-year requirement in many cases. But again, the 5-year concept is tied to specific conditions. That's why it gets confusing. So instead of trying to memorize everything at once, we'll use a simple structure. I'm going to explain the 5-year logic in 3 layers. Layer 1 is what the 5-year idea is trying to do. Layer 2 is where people get the timeline wrong. Layer 3 is the practical checklist you can use to avoid mistakes. Let's start with Layer 1. The 5-year concept is designed to prevent people from immediately using Roth structures for short-term tax games. It creates a timeline requirement in certain scenarios, especially when earnings are involved or when conversion-related penalty rules apply. Now, Layer 2 is the confusion. People often assume the 5-year rule always starts from today, or always starts from your account opening date, or always starts from your last contribution. That is not a safe assumption. A safer approach is to focus on what you are withdrawing and which clock applies in that context. Now let's get practical with a simple scenario model without unnecessary complexity. Scenario A is withdrawing Roth IRA contributions. Many people are surprised to learn that Roth IRA contributions have flexible access rules compared to earnings because contributions were already taxed. However, the broader rules and conditions still matter, and you should confirm the category and your situation carefully. The key point for our purposes today is this. When you withdraw, you need to know whether what you are taking is contributions, conversions, or earnings. That classification drives the timeline risk. Scenario B is withdrawing conversions. Conversions can involve a separate timing consideration to avoid certain penalties depending on your age and circumstances. Scenario C is withdrawing earnings. Earnings are where qualified versus non-qualified matters most, and timing is a major part of that analysis. Now, the next piece that causes confusion is ordering. The tax code uses ordering rules for Roth IRA distributions, meaning the system considers withdrawals to come from certain categories in a specific order. You do not need to memorize every detail to act safely, but you do need to respect that withdrawals are not always random. The classification and ordering affects what consequences might exist. Now let's define the 5-year concept in the way that helps you act. A 5-year requirement is often about whether certain Roth IRA earnings can be considered qualified, and about whether certain conversion-related withdrawals trigger penalties in some cases. The details can vary by situation, so your job is to identify which timeline applies before you act. Now I'm going to give you a clean timeline explanation that avoids most confusion. Think of the 5-year rule as a clock, but not every Roth IRA question uses the same clock. Some questions use an account-related clock. Some questions involve a conversion-related clock. And some questions are simply not about a 5-year clock at all because they are contributions-focused. So the right first step is to identify which clock you are dealing with. Now I'm going to walk through a practical timeline framework using simple language and careful wording. Step 1. Confirm what you are withdrawing. If you are withdrawing an amount that can be fully covered by your lifetime Roth IRA contributions, then you are dealing with contribution classification first. If you are withdrawing beyond contributions, then you are entering the conversion and earnings territory, and the timeline questions become more important. Step 2. Confirm whether the withdrawal is from a conversion amount. If you converted money into a Roth IRA, you should track the conversion year and understand that conversions can have their own timing considerations. Step 3. Confirm whether the withdrawal touches earnings. If earnings are involved, then qualified distribution rules and the 5-year concept can matter significantly. Now I want to address the biggest practical mistake people make with the 5-year concept. They assume my Roth IRA is older than 5 years means every Roth IRA withdrawal is automatically simple. That assumption can lead to incorrect decisions, especially if you are mixing conversions and earnings, or if you are operating near boundary conditions. So we need a checklist that forces clarity. But before the checklist, I want to give you a clean language test that helps you classify your situation quickly. Ask yourself this question: am I taking out money? I contributed money, I converted, or growth that the account produced? Those 3 words are your anchor: contributed, converted, growth. Now I'll add another practical anchor: records. The most common reason people get confused is not intelligence. It's missing records. If you don't have a clear view of your contributions and conversions, you can't classify cleanly. So part of the 5-year rule safety strategy is documentation. You want to know when you opened your Roth IRA, when you made contributions, and whether you made conversions, and in which year. Now let's do a short mid-video recap, because this topic gets messy fast without structure. The Roth IRA 5-year concept is not one universal rule applied the same way in every scenario. The consequences depend on what category of money is being withdrawn, and the first step is classification, contributions, conversions, or earnings. Now we move into a practical decision framework. I'm going to give you a conservative approach that keeps people safe from accidental mistakes. First, confirm your Roth IRA history. Do you have a Roth IRA that has been established for multiple years? Second, confirm your contribution totals. How much have you contributed across time? Not how much is in the account. How much was contributed? Third, confirm conversion history. Have you done any Roth conversions? If yes, identify the years. Fourth, confirm the type of withdrawal you are considering. Is it for emergency cash, needs a planned expense, or retirement use? Now, here is where the 5-year timeline usually causes confusion in practice. People mix up 5 years since the first Roth IRA contribution with 5 years since the last contribution, or 5 years since the last conversion, or 5 years since the account was opened. Different contexts can refer to different clocks and rules. That's why generic advice online can be dangerous. So instead of relying on generic advice, you do this. You confirm the exact scenario in official guidance or with a qualified professional, especially if you are withdrawing beyond contributions or if conversions and earnings are involved. Now, I want to keep this video useful for action, not just theory. So I'm going to give you the safe checklist version that fits most viewers. This checklist does not claim to replace professional advice. It is designed to help you avoid the most common category errors. Here is the checklist. Checklist Item 1. Identify your withdrawal amount. Write down the exact amount you plan to withdraw. Checklist Item 2. Identify your Roth IRA contribution total. This requires records. Use your brokerage history and your tax records. Your contribution total is what you put in over time. Checklist Item 3. Compare the withdrawal amount to your contribution total. If your planned withdrawal is less than or equal to your contribution total, you are in a simpler classification zone. You still confirm rules and documentation, but the timeline risk is often different than when earnings are involved. Checklist Item 4. If your withdrawal exceeds your contribution total, identify conversion amounts and years. This is where people get into trouble. If you have conversion amounts and you do not track them, you are guessing. Checklist Item 5. If your withdrawal exceeds contributions and conversions, then earnings are involved. That is the highest risk zone for mistakes. That is where qualified distribution conditions and timing become critical. Checklist Item 6. Confirm the relevant timeline conditions before you act. Do not rely on "I heard it's 5 years." Confirm which 5-year clock applies in your scenario and whether any other conditions apply. Checklist Item 7. Keep documentation. Save confirmation of your contribution and conversion history, because the ability to prove classification matters. Now I'm going to add one more practical point. People forget multiple Roth IRAs. Some people have multiple Roth IRA accounts sometimes at different brokerages. This can create confusion if you track only one account's history. So if you have multiple Roth IRA, as you need a unified view of contributions and conversions across all of them. Now let's address the mistake that causes unexpected taxes, because that is what people fear. Unexpected taxes and penalties often happen when someone assumes a withdrawal is Roth, and therefore always tax-free without confirming whether earnings are involved and whether the distribution is qualified. Again, I'm not here to scare you. I'm here to push you toward correct classification and proper confirmation. Now, to keep this video grounded, let's run through a clean example narrative without heavy math. Example 1. Someone has a Roth IRA, has contributed over multiple years, and wants to withdraw an amount that is clearly within total contributions. The primary job is verifying contribution totals and keeping records. Example 2. Someone has done conversions and wants to withdraw an amount that reaches into conversion territory. The primary job is identifying conversion years and confirming any timeline considerations that apply to those conversions. Example 3. Someone wants to withdraw an amount that reaches into earnings. The primary job is confirming whether the distribution is qualified, including timing and other conditions. That is the clean model: contributions, conversions, earnings. Now I want to give you a simple habit that prevents 5-year rule confusion from becoming a problem later. Every year when you make a Roth contribution, note it in a simple tracker. Amount and year. Every time you do a conversion, note it separately. Amount and year. You do not need advanced software. You need clarity. This habit makes future decisions easier and safer. Now I'm going to give you a short summary in one paragraph that you can remember. The Roth IRA 5-year concept is about timing, but timing is meaningful only after you classify what you are withdrawing. Your first step is to determine whether your withdrawal is covered by contributions, reaches into conversions, or reaches into earnings. If conversions or earnings are involved, do not rely on generic advice. Confirm the applicable timeline and conditions with official sources or qualified help. Then, document everything. If you want the checklist pinned comment 5-year, and I will pin it at the top. This content is for educational purposes only and is not financial advice. Always review official guidance and your account records and consider professional help for your specific situation. If you want the next video in this series, watch the episode on Roth overcontribution, because mechanics errors that can also create avoidable problems. You're watching Wealth Architect.